Let me turn to my final point, which is about financial stability and monetary policy. So I've talked about various financial market phenomena, inflated asset prices, high asset price volatility, and heightened merger activity. These financial market phenomena could potentially pose macroeconomic risks. Now, I'll start off by saying these potentialities are best addressed, in my view, through effective supervision and regulation of the financial sector. Nonetheless, it is possible that these supervisory and regulatory tools may only partially mitigate the relevant macroeconomic risks. How, if at all, should the FOMC adapt its monetary policy in response to any residual risks after the application of these other tools? To answer this question, the committee will confront an ongoing probabilistic cost-benefit calculation. On the one hand, raising the real interest rate will definitely lead to lower employment and prices. On the other hand, raising the real interest rate may reduce the risk of a financial crisis, a crisis which could give rise to a much larger fall in employment and prices. So the committee has to weigh the certainty of a costly deviation from its dual mandate objectives against the benefit of reducing a probability of an even larger deviation from its objectives. Now, as I talk about this probabilistic cost-benefit calculation is conceptually challenging today. It's going to remain so for some time to come. But it is important to stress that the committee is in a better position, and I would say a much better position, to address this challenging question in 2013 than it was in 2007. The Federal Reserve System now dedicates a significant amount of our best staff resources to financial system surveillance. In fact, the Federal Reserve Bank of Minneapolis contributes to these efforts in a number of ways, including our ongoing monitoring of the risk-neutral probability distributions of future asset values. As a result of these efforts, the FOMC has a lot more information on an ongoing basis about the extent of financial system risks. Nonetheless, as always, there is more to be learned. We need to understand better, in light of the current state of supervision and regulation, which residual financial system risks have the potential to translate into macroeconomic risks. And we need to understand better to what extent monetary policy tightening can in fact temper those residual financial system risks.